Okay. I formalize all this conversation in this this PowerPoint. So this PowerPoint is basically um, a, a, a written description of what I have verbally explained in this previous one. Okay. So I'm just leaving it there for your benefit. Don't forget that these are historical averages. This is not. So while this is historical, right? Okay. Because we were trying to find the price of risk. Sorry about that. This is not historical. This is the current yield to maturity. So think of it this way. You say, okay, this is an investment. I know the beta for my investment. I know this. I know the price of risk, suppose 10%. So today, if I invest today, what would I get today without any risk? Okay. And in my example, remember it was 1%. Okay, so this is the current or today's yield to maturity. Okay, so all you're saying is if I put my money today in this company, then what is the return I should require? What I would otherwise get today, 1%, and then you add the market risk premium that I've already explained. Okay, so let's kind of make this more, you know, more self-explanatory. And let me just start by reminding you that the whole process is behind the CAPM is remember to find the risk-free rate, right? Plus, right, the market risk premium minus the risk-free rate. These are historical averages multiplied times your company's beta. Okay, so how do I find this? How do I find this information? Well, this information is you can find it by downloading market price information or by looking at published information. I'm going to do this a little bit longer than I should, but instead of just giving you the numbers, I'm going to give you an example of the data that has been collected for the U.S. case. Now, this same data can be assumed or used for different countries around the world, depending on which country you're studying. Let me just give you a numerical example with what we have here so that we can understand what the logic is, right? So what is the market return? So I'm trying to find, remember, I'm trying to find right now the risk premium. Okay, I'm trying to find this basically. So this is an exercise to kind of help us determine, the logic behind this number. So the large company stocks, on average, have given me 11.8% return. Okay. Now, if I say that large company stocks have earned on average for the past X number of years, right? There's quite a few number of years here. 11.8%. What am I really giving you? What is this really representing? This is representing the average market return. Okay, that's 11.8%. Now, if I want to find the market risk premium, what else do I need? I need the market return, and I also need the average risk-free rate. What is the risk-free rate for, let's say, for Google? If I want to use the market risk premium for Google, right? What would be the risk-free rate that I would use? Would I use a 10-year government bond, or would I use a 10-year government bond? Okay. Now, of the two, the treasury bills are too short because these tend to be, 1 year or less. Okay, these we cancel out. So of these two possible candidates, which one will you use as a risk-free rate for Google? One would argue, well, Google's going to have, yeah, it does have some long-lived assets, right? But basically, most of its assets are not considered as having long useful lives. So of the two, I would probably choose this as my risk-free rate. So this is my RM. This is my risk-free rate, average risk-free rate. So what is the market risk premium that I would use for Google? It would be market return of 11.8% minus the 5.6%. Okay. So overall, my market risk premium will be 6.2%. That's my market risk premium for Google. Okay, and what would I need to do in order to find the required return for Google? I would have to multiply that times, this is my market risk premium, times Google stock beta, right? The beta. And remember, it was 1.27. Okay, So 1.27 times the market risk premium plus the current government yield. That, whatever this is, that will be my expected or required return. That's the return you would demand for investing in Google stock. Okay. So let's put all these things together. Okay. To find the risk-free rate of interest, right? We have to obtain the current yield to maturity for a government bond that's a 10-year average, right? Okay. Let's suppose in my example, let's suppose that it's, we said 1%. Let's continue with that example. Okay. So suppose that is that 1%. What is the market risk premium? The market risk premium we said was 6.2%, right? 6.2%. What is the beta coefficient? 1.27, right? So the expected return for Google stock is 1 plus 6.2 times 1.27. That will equal to 8.87%. Okay. Of course, you can always argue, well, but yes, but in different regions this is different, is it not? And the answer is yes, it is, right? So the risk-free rate, let me just, this is risk-free rate, sorry about that. Okay. The risk-free rate, the government bonds will give me, my country, 10%. All right, so in that case, because of inflationary conditions or any other conditions, then if your risk-free rate is 10%, and even if you assume that the rest of the numbers are the same, then of course this changes, everything, right? That would be, now you would have to add that 10% to that product, right? So it will be, your number will be enhanced by, let's say, by 9% more, right? So you would be around, that would be 17.87. That will be your required return under a condition of a market that has, high opportunity cost of capital because of inflation.